Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.
Hello and welcome to Inside Options. I'm James Boardman. In this episode, it's back to the textbook stuff. There's quite a bit I have to show you, but it will be interesting, I promise. So options are unique in their flexibility because you can do option strategies. This is combining different options with different strikes, and by buying and selling these options in a combination, we can profit from any type of market conditions. So these strategies have funky names like a straddle, a fence, a butterfly, or a condor. So these names are given to certain combinations of options that are bought and sold, and they create a unique payoff profile. Tonight we're going to learn some of these payoff profiles and have a quick look at when to use some of these strategies. So these strategies are incredibly useful and allow you to express any particular view you have on a market or on a particular stock. So if you are convinced that nothing at all is going to happen to a stock and its price won't move much, you could sell options on it and thus earn a decent rate of return even if the market just went nowhere, it was just flat. So a fund manager trading on the exchange made a really interesting trade a few months ago. So I looked at it, I was kind of baffled, I was thinking, what is this guy doing? It's actually a really quite an interesting trade. So what he did is he sold a call and he sold a put on Massmart. We call this trade a strangle. Now selling a strangle is a pretty risky move, which most of the time only a bank would possibly be interested in. So what view was he expressing with this position? He was actually saying that the Walmart-Massmart deal would go through. And there were all these hearings and there was controversy in the media and whether it would go through the competition tribunal. It actually did. Thus, the price would stay between the two strikes and gravitate around that offer price, and he would collect two sets of premiums. So he was right. It did go through. And he earned a nice return by expressing his view using options. You know, simply using futures or stocks, there's far less sophistication and nuance available to express whatever particular view you might have on the market. So trading shares and futures is kind of like making music using just a drum. Using options enables you to trade like Yo-Yo Ma using a Stradivarius cello. There's far more elegance and a wider range of notes and noises become available. So around the world, many hedge fund managers use options to successfully trade in lots of different market conditions. So in the global meltdown of 2008, a lot of the most successful traders use put options or instruments similar to them, like credit default swaps, to profit from a falling market with a limited risk. So in Australia, they call the global financial crisis the GFC, which I quite like, as it sounds less scary and more approachable. I think understanding some of the lessons learned there, it helps to just turn it into an acronym and talk about the GFC. So at the exchange, we've developed a really useful poster, and you can email me at jamesbo@jse.co.za, and I'll be happy to send you a copy of it. We have it in A2, A3, and A4 sizes. You can also download this poster in a vector image, which means you can blow it up huge and it stays nice and crystal clear, and that's in PDF format, and that's on our website at jse.co.za/options poster. And we're going to look at this poster tonight in quite some depth and chat about some of the strategies you can do. So I've got a slide here of the poster. We can actually see that it's got sort of three broad colors, and these three colors are telling us when to use it. So you can see there's bear strategies. Let me zoom in a little bit more. There you go. Bear strategies and neutral strategies. Now bear strategy is when you think the market's going to go down. Sort of the broad market conditions going to dictate what you're going to trade, what kind of strategy you're going to employ. So another one is the short straddle. That's also a neutral strategy. Bear strategies, you think the market's going down. Neutral strategies, you think the market's going to be flat. So it's going to be, you think the market could be either up and down, quite volatile, but you're not sure which way, or you think the market's going to be fairly flat. So those are the neutral strategies. A bull strategy are the green strategies. These are what you use for times when you think a particular stock or you think the market is going to go up. So these categories, bearish, bullish, and neutral. So there's another really interesting part of this graph, which is the option strategy spectrum. So that option strategy spectrum has bearish strategies, neutral, and bullish. Now, that's a bell curve. What a bell curve does is along the x-axis is how extreme the move is, a percentage move, and on the y-axis going up and down, that is then how often that move occurs. So most of the time, neutral strategies, the market's not going to move significantly in either direction. When the market is moving a lot, either up, you'd be very bullish, or on the far down-hand side, on the left-hand side of the graph, we'd say we're going to be very bearish. So that is what you're looking at here, is bearish. How bearish are you? Very bearish? You'd buy a put, just a put on its own. Bullish? You're very bullish? You'd buy a call just on its own. Now, an interesting thing about options is there's a misconception out there in the market that buying options is inherently very risky, very aggressive. You have to have strong conviction in your move. If you think about it, for an option on sort of an at-the-money call, you're bullish on a stock, you're going to put down about 10% of the value of that stock. I'd actually say you've got to be far more bullish about it to put down 100 Rand to buy a share than to put down 10 Rand to buy an option. It's actually you can actually be less convinced of your move just by buying an option, because you've got that limited exposure and you get that geared upside, that fantastic lopsided leverage that I bang on about so much. So now we have to take a short break, but after we come back, we're going to be looking in more depth at some of these strategies.